What's going on, income investors? Welcome to my channel. I am the Covered Call guy, and on this YouTube journey, my goal here is to create $120,000 in annual passive income. I am currently holding 6 Covered Call ETFs. At the end of every month, I will do a portfolio review, doing all of my portfolio's size, holdings, buy, sells, or doing nothing and just holding cash. So projected annual dividend slash distribution income is about 70 grand a year, 5.8K a month, 1.3K a week, $191 per day, and about $7.99 per hour. All right, legal disclaimer before I start this video: this content is for informational and educational purpose only and should never be considered financial, investment, or tax advice because I am not a licensed financial advisor, investment professional, or tax expert. All opinions expressed are my own and may be inaccurate or incomplete or just flat out wrong, so please conduct your own due diligence and consult with a qualified licensed professional before making any financial or investment decisions. Remember, guys, I am just some random idiot you found on YouTube, and I could be completely wrong. All right, with that out the way, let's get started on today's video. Here is my very opinionated view on covered call ETFs versus, sticking with a job. I want to say covered call ETFs are the financial version of job hopping, okay? And that's exactly why they work for me. I don't pray to the 40-year compounding gods. I want to get paid today. Okay, so let's look at the cult of compounding, right? The financial industry is obsessed with a utopian fantasy, right? You hear it all the time, especially these wealth managers, these FAs, and all of the talks when you do your, your deep dives and you do diligence on Reddit, X, wherever you want to do your deep dives, Google, right? Articles, and you start reading about it, right? Index fund peers worship at the altar of long-term compounding. Not that they're wrong, but you know what? I'm pretty sure it's not for a lot of younger millennials and even the younger Gen Z, right? So my peers, it's just not for us anymore, right? Why? The Gen X and Boomers, they preach that the ultimate financial virtue is buying equities and waiting for 40 long years. Extracting cash today is viewed as a cardinal sin, right? It's like, oh my God, what are you doing? You're young, you can let it grow for 30, 40 years. But their dogma is completely wrong for the brutal reality of my life. And if you're on this channel, if you're a viewer, if you're a subscriber, if you're a supporter, it's probably wrong for your life too, right? Wall Street wants me to wait for 40 years. I want to take my cut today. Right, so let's look at the labor market reality, okay? A lot of people don't talk about this, but, being young in my early 30s, right, we have to look at the labor market and how it's changing so rapidly the last 3 years, 5 years, and I want to say even the last 10 years, okay? HR departments preach corporate loyalty, right? Promising me equity upside decades from now if I stay quiet and work hard. The reality is a lower employee, right? For the most part, if you're if you like get a 2% annual raise, like, oh my God, I got a 2% annual raise, like that's good on paper. Meanwhile, I've done this myself. I've been hopping. Every year to 2-3 years, I've job hopped. The last 5 years, I switched over to like 3 jobs, right? When I job hop, right? Changing companies every 2 years, I command a massive 30% salary increase. And even a 10%, right? I say 30%, but even a 10% is great. This is how you really speed up your financial freedom, because I refuse to wait for a payout that might never come, okay? Don't worry. Look, ever since they got rid of pensions, corporate loyalty is dead. Holding stocks forever is just foolish, okay? This is not the 1950s, 60s, 70s, or 80s. They started to change in the 1990s, and then by the early 2000s, you started to see it. And not the mid 2010s, 2020s, you've seen people can't even get jobs anymore, let alone hold a job for 1 or 2 years, right? So let's think of it that way. Job hop, right? The only loyalty you should have to yourself is the money they're giving you, the pay raise. Right? Mapping the dynamics, I'll split this into 2. One is the corporate loyalty, right? They buy and hold. Okay, that might be some of you watching and you found my channel. That might be you right now. You are the traditional buy and hold, right? Maximize capital appreciation, perfectly mirroring the deferred gratification of corporate loyalty. You wait for decades for a theoretical payout, completely ignoring your present reality. Now, this is more of me, and for those who support the channel, you might be the job hopping, right? Job hoppers. You are the cover call income investors, okay? Us cover call / income investors, right? Maximize immediate income generation, right? They are absolute financial equivalent of my job hopping, okay? That's how I kind of compare it. I maximize my immediate Tangible cash flow today. I'm not waiting, right? I'm going to switch jobs if someone else offers me a 30% increase. Because I start the job 2 weeks, I see an actual increase, right? I see in my bank account. Okay. Job hoppers get rich today. Loyalists get a plastic plaque in 20 years. I mean, if that's okay with you, then that's okay with you. All right, my mercenary tool. Okay, so maximizing my income today is the only rational strategy. Okay, waiting for terminal wealth decades from now is a blind gamble. It might pay off, it might not. I'm not willing to take that risk. Okay, cover call ETFs are my portfolio's tool of the mercenary. That's my mercenary. I'm putting my warriors to work. Right, they're designed not to win a spreadsheet simulation in 2060, but to fund my financial independence right now. I want to extract the cash now, let the peers cry over the spreadsheets 20, 30 years from now, 40 years, it might not even happen. Okay, cash flow will always beat paper wealth. Modern portfolio theory is fundamentally flawed. And why? It confuses net worth with actual financial independence. It's two separate things. Financial independence is achieved when the velocity of my passive income exceeds my living expenses. Period. Done. Case closed, dispute over. There's no more counter critics, rebuttal. That doesn't matter. That's the end of it. My cash flow destroys paper wealth because it provides immediate spendable utility. I can pay my bills. Your paper wealth can't do anything for you. It's literally a locked number on your screen. It looks nice, it makes you feel good, but that's about it. Right, so a traditional portfolio leaves me completely at the mercy of market valuation when I need liquidity. If I rely on capital appreciation, I'm forced to sell my assets to survive, which leads to income velocity is the only metric that creates true stability. Okay, I can't buy groceries with abstract net worth. Right, cash is king. Cash will always be king. Right, my salary replacement ratio, looking at, for an example of a $10,000 monthly deposit, right, there's a brutal behavioral reality is that I think in salary terms, not net worth. Looking for an example, a $2 million portfolio balance is just fluctuating numbers on a screen, right? A $10,000 monthly cash deposit is a risk grow undeniable reality. It actually hits my bank account. I get to use it. Right, my cover call ETFs convert my capital into salary like income. Right, that bridges the gap between abstract wealth and tangible lifestyle funding. So stop tracking your net worth and actually track your paycheck. The 40-year fantasy. Oh God, some people will defend this till the end. You know what, but at the end of the day, it's not wrong. Right, some people are just born to do this. They love it. I don't know. I will personally never understand it, but some people, they will work until they can't work anymore. Hey, the 40-year buy and hold model is a mathematical fantasy, at least to me, my opinion, because it assumes a friction-free life where I never lose my job. Right, that's the first question I ask. Like, okay, you're putting all this money, but what happens if you lose your job? You can't find a job for 1, 2, 3 years. You never suffer a medical emergency. Okay, let's just say you worked for 20 years without ever getting laid off, and then you have a severe medical emergency. It completely drains all of your cash. Or never face an inflationary shock that forces me to liquidate early. So at least in my real world, life is chaotic, right? Unpredictable and entirely almost out of my control. Right? Things happen. A 40-year spreadsheet assumes I don't ever get sick or fired. Right? Wake up. That's not true. These times, these ever-changing times, it might have worked for the boomer. It might have worked for Gen X, but it's not working for us millennials and Gen Z. It's just not. It's crazy to think that, a lot of boomer and Gen X, they didn't even need college, right? Right out of high school, got a good paying job. Right now, you need a 4-year degree, can't even land you in an interview. Right, you need to go above and beyond, and even then, it's not guaranteed. Okay, the luxury of the academic, like I've been mentioning, economic conditions shift aggressively. Recession frequently forces me to liquidate my assets at the absolute worst time possible. Okay, so we're gonna be looking for, 2060. We're gonna say, look at this. Scenario here, right? It ignores reality that life shock will disrupt your entire timeline. Because 2060, 40 years from now, you can't predict any of it. I mean, every year, 3 year, 5 year, right? The strategy prioritizes robust current cash flow because it is inherently more resilient to the vicious unpredictability of my life. If I have cash coming in every week or every month, I know it's coming in, right? I don't have to wait for it, right? I know I can plan things out much better. Optimizing for 2060 is pure luxury. It is, I want to say, it's almost gamble like. Sure, things go, GDP is always going to go up in a way that market will always go up, yes. But like I said previously, what if you lose your job, medical emergency, anything else that can happen while you're building and waiting, right? I survive in the chaos of now. All right, selling convexity for cash. I'm gonna split this into two again. First is the mathematical truth, right? Equities derive their massive returns from extreme right side events, all right? So a property known as positive convexity. For example, my cover call strategy systematically destroys this dynamic by holding the index and writing calls options against it. Leads to the other half of amputating the tail, right? The strategy caps my upside return in exchange for immediate, undeniable upfront cash premium. Whether that's good or bad, you have to decide, right? Obviously, if we're talking about, job hopping, this might be good. You can turn this into a positive. Because I am deliberately amputating the right tail of my return distribution, I'm explicitly selling my market convexity for hard cash flow, okay? If you amputate the right tail, sell the convexity, take the cash. Now, what you do with the cash is all entirely up to you. All right, let's look at the undeniable parallel, okay? We're going to do job hopping versus corporate loyalty. If you look at this, obviously, simply, I'm trading away uninvested startup equity for a massive base salary bump today, right? As a cover call investor, I trade away the unpredictable upside of the market for a massive distribution yield today. I optimize for absolute present day utility, okay? I'm trading unpredictable upside for a massive guarantee yield. Okay, so where does my yield come from? Of course, you have to ask, right? You do have to ask. It's kind of like job hopping, and it's like, okay, this pay raise, like, I gotta ask, where exactly it coming from? The market is kind of the same way, right? So if my strategy limits upside, where does my double-digit yield come from, right? It is my monetization of structural market inefficiency, known as RVP, Volatility Risk Premium. Let me break it down. It's the simplest way I can break it down, right? Expected fare, which is an IV, minus actual fare, RV, equals my free paycheck, your premium, your payout, your distribution, okay? The market systematically overestimates future volatility. That means I get paid in cold hard cash for that mathematical error, okay? I don't create wealth from thin air, right? I just monetize structural fare, okay? Becoming the house, right? I've been saying this in a previous video. You know the saying, the house always wins? This is exactly what I'm doing here because IV is greater than RV, right? I consistently collect a rich premiums, right? So a lot of institutional hedgers are terrified. They must purchase downside protection regardless of the cost. I use covered call ETFs to act as the insurance underwriters, okay? So I essentially become the house. I collect a massive premium for absorbing the market's risk, right? The yield is my paycheck for providing liquidity to panicked institution. And I want to say the saying, right? The house always wins. I stopped gambling and start underwriting the casino. That's how you got to think of it. All right, optimizing for paychecks. Split into 2 points again. First point is missing the point, right? Standard financial advice aggressively penalize cover calls for underperforming the total return of the S&P 500 during bull markets. This is always going to be the biggest counterpoints that you will always hear. I want to say they always completely miss the point because as an income investor, I am solving a radically different equation, right? Solving the problem of today, not for the total return of 20, 30, 40 years down the road, right? This is my rational choice, okay? While traditionalists optimize for maximum terminal net worth, I optimize for maximum sustainable paychecks so I never have to rely on selling assets, okay? Two completely different points, goals, and lifestyle. I rationally choose a massive cash yield over unhedged equities. I want the money now, okay? Standard advice misses my point, right? I optimize for paychecks, not for the higher score. Okay, my total return objection here is split into 2 points again. First is to address the criticism, right? Critics will always claim a cover call strategy underperforms a broad equity index during sustained bull runs, right? They look at total return and declare victory, but they are dead wrong about my actual goals. My reality is that the relevant comparison is a withdrawal portfolio. If I rely purely on equities, then I must periodically sell my shares to live. So when my withdrawals are factored in, the performance gaps vanishes. Okay, this is a withdrawal optimized weapon. They don't see it that way. All they see is the end game number, the end game, higher number, and it's okay, you lost there. Yes, I will underperform bull markets, but I withdraw cash without cannibalizing my core. That is ultimately the end game. I'm living off my portfolio. All right, again, anchoring my psychology. Okay, this is very big for us income investors. Okay, we do have to control our own mental psychology because it plays a huge role. Market volatility won't destroy my wealth, my own psychology will. This is what we call behavioral finance, right? Proves that human beings panic sell. A pure total return portfolio breaks me mentally, of course, right? Looking at the higher numbers, like, oh, maybe I did something wrong. But when the market drops 20%, my net worth plummets, right? My instinct is to flee, right? But this is where my cash flow anchors my behavior, okay? A high, consistent distribution yield provides me ironclad psychological comfort during the worst crashes, okay? You are your own worst enemy, okay? Psychology destroys wealth faster than crashes. High yield prevents the panic, okay? My real retirement risk, we're going to talk about the good, the ugly, the bad, the beautiful, right? The dominant mathematical threat, I mention it always on all my videos, is SORR, sequence of return risk, right? If I'm forced to sell shares to fund my living expenses while the market is down 30%, you lose those shares permanently. You will miss the recovery entirely, okay? This is where this plays such a big role, where my cover call strategies give me a mechanical advantage by sacrificing some market upside depending on what you buy. Of course, I buy absolute immunity from being a forced seller. Selling assets during the market crash downturn is always going to be financial suicide, okay? Income immunity is my lifeline. My portfolio's income engine, of course, I got to talk about some examples here. These are examples, guys. Okay, I'm not advertising for any of these, just examples. Okay, of course, it is intellectually dishonest to compare an income ETF to a broad market index. Okay, it is not a growth vehicle. Okay, so when you do your deep dives and you always hear the counterparts, understand we income investors. Okay, this is not a growth vehicle, so you can't compare it to it. It is a pure income engine of my portfolio. So we have to look at actual tools, that's available to us. Let's look at JEPI and DIVO, right? These are actively managed defensive sleeves, right? DIVO tactically calls on concentrated, high quality dividend growers. Okay, lower volatility, stable yield. JEPQ and QYLD, these are the heavy NASDAQ 100 exposures. They capture massive option premiums from tech volatility, high yield, higher risk, okay? The entry point here is that you never buy blindly, right? You track the NAV and buy dips when the RSI is below 30 and implied volatility spikes to mathematically lock in a higher yield on cost, okay? Don't treat an income engine like a growth rocket, right? It's a cash machine, so understand your actual portfolio, okay? You treat it like a growth and you're going to have a lot of issues. You're just not going to see the results you want to see. Okay, my barbell portfolio. Of course, you want to talk about not going all in, right? You always want to construct a barbell portfolio to achieve a perfectly balanced, aggressive approach. One is your growth sleeve, right? Growth sleeve. Broad index exposure to capture long-term compounding and convexity. This builds your future and possibly helps build the future if you want to pass it down for someone else. And then the other half is your income sleeve. Covered call ETFs harvesting volatility alongside a fixed income instrument. This funds your present. Okay, always barbell your portfolio. Have a plan for it. Growth for the ego, income to pay the bills. Right, my tax efficiency split into two. Right, the distribution mix is tax classification is critical, unavoidable factor here. Okay, my cover call distributions are comprised of option premium incomes, capital gains, and return of capital. Again, we will never know until the end of the year. They can put out all of these 19 notice 19 alpha, but it could be false. Okay, these are just estimates. And then the jurisdictional advantages here is that this structure can offer serious tax advantages relative to traditional dividend income. So again, relentlessly evaluate these implications. Of course, you don't want to give anything extra to IRS. Okay, tax efficiency matters. Trade-off and limitations. I'm gonna be brutally honest here about the trade-offs, right? I embrace them openly, and as you, an income investor, covered call ETF investor, you have to embrace them openly too. Split into two parts. First part is limited upside, right? The drawdown is always going to be capped upside to a certain extent, right? When market explodes higher, your written calls limit participation. This is structural. This is part of the strategy, right? You are deliberately exchanging future gains for guaranteed cash today. And second is the NAV erosion, right? So because depending on about 90% of these covered call on the market right now, these funds distribute huge income. Your underlying share price may decay. Understand what you're buying, know what you're buying, okay? Key metric is always going to be total income plus residual capital, not just share price appreciation. Okay, you have to watch the NAV like a hawk. Understand that you don't want the NAV to be destroyed. Otherwise, there is absolutely no point. Right? Know your trade-off, cap upside, and NAV decay. Take the cash anyway. All right, my market regime. Understand that cover calls perform best in sideways volatile market. Explosive bull markets always favors pure equity. You're not going to beat a bull market, okay? And severe bear markets reduce premiums while equities fall. So it is my complement to growth, not a total replacement. And then distribution variability. You guys, for those who are not new or already seeing it in my month-to-month update, right? It really changes month to month. The payout is option premiums, right? So it's not like dividends, okay? Distributions are not guaranteed. Option premiums fluctuate directly with market fear. So account for this, okay? I do it. I account for my variability in my monthly payout and aggressively adjust my life accordingly, okay? An imperfect paycheck today beats a perfect theoretical spreadsheet tomorrow. So if you know you need $5,000, to sustain, always aim for $7,500, right? That way, if it ever the option premiums kind of shrinks, you still have that buffer. All right, the job hopper portfolio. Look at terminal wealth maximization is an elegant theory that completely ignores my actual reality. Okay, traditional buy and hold assume I wait for decades for compounding. My life does not unfold on an uninterrupted timeline. My career shifts, the economy breaks, and my financial need emerges right now, long before a 40-year horizon elapses. Okay, my job hopping isn't disloyal. It is rational. Just like my cover calls, it's rational, right? You guys are going to get in and out of certain ETFs that no longer fit your goals, that no longer fit your thesis that you invested in. And that's what it should be. If your job is not paying you, giving you a raise that you need, leave. All right, optimizing for objectives. All right, let's look at the split into two here. We have the corporate loyalist. Could be some of you. I don't know. Again, nothing wrong with that. The loyalist always waits patiently for equity appreciation that may or may not materialize, right? Decades later. If I want a high score on a spreadsheet when I'm 80, stick to pure equities. You win no matter what. You will win. At the end, the highest net worth, you're going to win. Versus the job hopper path, which is myself and maybe perhaps you, right? As a job hopper, I capture massive salary growth today by renegotiating my value right now, right? I seek true financial independence defined by consistent cash flow, okay? Cover calls give me this freedom, right? I take control of my value today. I don't want to wait for permission to be wealthy decades later. If you have that same mindset, you know where you have found the right channel. Okay, my final question from me to you is, traditional investing begs me to maximize wealth in a distant, uncertain future. My philosophy asks me one brutal question, right? How much does my portfolio pay me this month? Ask yourself that. In a world defined by economic chaos, inflation, volatile careers, a portfolio that acts like a paycheck is vastly superior to a theoretical fortune decades away. Okay, valuing cash today over empty promises tomorrow is not just a strategy. Okay, understand that it is absolutely the most rational way you and I can operate. How much does your portfolio pay you this month? This is the only metric. And how much can you grow it the next month and the next month and a year from now? How much of a pay raise can you give yourself? Keep asking yourself. That's the real question you'd be asking yourself. You got a job hop, right? All right. If you found this video fun, creative, entertaining, engaging, informative, you got something out of it. Of course, if you're new, give me subscribe, like, comment, let me know down below, right? Or you're a corporate loyalist, right? Nothing wrong with it. Some people are meant to be wage slaves. If you want to work 30, 40 years, of course, some people are like that. Or you're a job hopper like myself, okay? I appreciate it. Thanks for helping the channel grow. Of course, my portfolio isn't the only thing growing today, and hopefully new viewers give me a sub so my channel can grow too. Thanks for watching, guys. Stay tuned. Catch you guys in the next.